TheoTrade. This is Don Kaufman. August 12th, 2022, doing the weekend update here on a Friday afternoon. 15 minutes left inside of the trading session, and it is a wild trading session once again to the upside. S&P is trading 1.6% higher. Yeah, again. I mean, the talk of the town out there is, it's back, baby. The bull market is back. There's all kinds of retail activity. What I mean by that is retail traders back in business right now, slinging option contracts like it's going out of style. I actually saw that yesterday, the options marketplace yesterday did 46 million contracts on a Thursday, which is, by the way, it's totally unheard of. That is an extremely heavy day. It's unheard of, though, with a marketplace. Well, actually, yesterday, the market didn't do anything. We finished massively unchanged. That's okay, though. We're ramping back up to the upside. So we're going to cover all of that. But this weekend's update is entitled Fed Pivot or Market Divot. What I'm actually referencing on that front, listen, is the Fed going to keep the foot to the accelerator when referencing, raising rates? Or is the marketplace all of a sudden going to realize the Fed may not back off the accelerator and we're going to take a little bit of a divot out of this marketplace? That would entail some sell side activity. So I'm actually going to kick off with that. Let's talk about the rally in a moment. Let's talk about the fact that people are like, it's a bull market, the bulls are back in town. We're going to come to all of that. And again, I'm actually going to give you, I'm going to give you logical reasons that we're rallying. Then I'm going to give you, for the most part, a little bit of an opinion piece on this particular rally. We're going to discuss a little skew, a little dollar. Dollar definitely remains defensive here. We're going to talk about it all here on this weekend's update. I'm even going to cover a bit of a discussion on gamma squeeze. But first and foremost, let's just have an albeit brief discussion, if you will, about inflation. So CPI number comes out this week, and everybody's talking about it. Listen, you can talk about it till you're blue in the face. Here is my analogy, if you will, for CPI. Listen, inflation, once it kicks off, if you look historically at inflation, once it kicks off, it kind of gets entrenched a little bit. And what's even compounding inflationary pressures right now, of course, is like the dollar. Because if the dollar is going up and the dollar is strong, it weakens like the euro, it weakens the yen, it weakens currencies all over the world where the dollar is actually headed up. And then we're basically exporting inflation because most of your commodity products, of course, are priced in dollar. The dollar actually goes up. It makes the commodity that much more expensive for anybody around the world. That's, you trade most of those commodities in US dollars. But the bottom line over there is that inflation, is kind of entrenched. It's going to take a long time for inflation to get back to, what's the Fed target? 2%, please, 2%. We ain't even in the same ballpark as 2%. But my analogy for this one is actually pretty straightforward. And, I've been talking about this all throughout the course of today because, I don't know, this one kind of struck me like last night. But, you look at inflation and it's 9.1% in the previous month. When I call it a freight train, and that's, I don't know, I like visualize, inflation being a freight train. This freight train going 91 miles per hour. A lot of people are like, hey, Don, a freight train cannot move 91 miles per hour. Yeah, I know that. That's why you have to look at this and how extreme and ridiculous it happens to be. So the Fed goes out, they do a little dance, they make a little love, they get down tonight. That train slows down to now 85 miles per hour. And quite frankly, the Fed interest rate increase had nothing to do with that. What actually slowed down the train just a hair was the fact that the energy prices, oil, came in big time. I mean, oil was trading, $110 a barrel. Things were getting all kinds of crazy. So what I am telling you is that you have an out of control freight train moving at 91 miles per hour. You put a couple of speed bumps in front of it. It slows down to 85 and you're like, it's okay. It's okay. Like the Russell's trading like 5% from its all-time high. The S&Ps are launching themselves. What do you think the Fed's going to do over here? This is not ambiguous. What do you think the Fed's going to do? And the answer is, well, they're still going to raise rates. They know that the freight train's out of control right now. In fact, don't listen to me. Look at the Fed fund futures. Look at the Fed fund futures. Here are the Fed fund futures. Now, I love to bring this up. It's the CME group. And the CME group, what you're actually looking at right now are, well, Fed fund futures. It's probabilities. probabilities for the September meeting. And effectively what the probabilities are presently saying, okay, and I'll just make this real clean and easy for you, because again, I feel like I'm explaining this every single time I bring it up, and that's this, okay? Right now, Fed fund futures are sitting at 225, 250, okay? Over here is about a 57% chance of a 50 basis point bump. Over here is a 42% chance of a 75 basis point bump. So for the most part, what are we saying? Absolutely nothing. Nobody's like decided that we're not going to have a 75 basis point increase over here because, well, Fed fund futures are pretty smart. By the way, if you looked last week, okay, and they have like 1 week ago, right? When I say 1 week, look, a week ago was the exact opposite. Like a week ago, they were like, oh no, 70% chance we're going to have a 75 basis point hike. For the most part, what am I telling you? Nothing's really changed. Okay. We have almost a 50-50 right now, whether we're going to see, that big of a hike again. But the market doesn't matter, right? Because right now we're back to the bull market. So I wanted to kick that off with the freight train, because the freight train, well, it's still a freight train. It's still moving at 85 miles an hour. It's still a considerable concern. Is it slowing down? Too early to tell. But the implications, the one thing I will actually throw an opinion piece on there is the implications of the Fed increase. You haven't felt them yet. You're not going to feel any implications of the Fed raising rates. Okay, maybe there's been a little pullback in spending, there's been a little pullback in hiring, but to further the whole inflationary, theme and how the Fed is going to go after it hard, the jobs number that came out, the jobs number was also stellar. Like the unemployment rate has actually come down. We're talking about like, 3.5, maybe 4% unemployment. The Fed's not concerned about that. So what are they going to do? Foot right down to the floor. They're going to continue to accelerate, okay, those rate hikes. And it doesn't matter whether it's 50 basis points, 75 basis points, still devastating. Could you imagine if they did 3 consecutive 75 basis point hikes? It ain't never happened. It's never even been anything close to that, right? So the bottom line is inflation's entrenched. It's going to be entrenched. We're not out of this situation by a long shot. Okay, and that situation, that's not an opinion. We are not out of this situation by a long shot when it comes to inflation, period. Okay, ooh, but the market feels disconnected. I got it, but we just talked about Fed fund futures. So back to the bull market, you ask? Well, here is the opinion piece. Okay, it's going to be a couple of days, a little while. Market's going to realize right now, though, that those inflation, horror stories, they're not over. Okay. We're only a hop, skip, and a jump off some very key and very marquee levels inside of the S&P. So I want to start with the fact that down here is 39, okay, like 31 in that neighborhood. It's a gravity point up here, okay. We happen to have 42.11. 42.11. Not only did we hit it, we talked about this incessantly last weekend on the video, the 42.11. Forget about down below right now, okay? The key level right now is the fact that we're at 42.11. We actually burst on the scene and up and over it, which is a little bit of a gamma squeeze, neither here nor there. Okay, because everybody's going to be asking me like, well, what would constitute a little bit of a pullback? First pullback, of course, would be to 42.11. Do I see a pullback coming in here? Oh, no, I mean, not today. We're in the midst of a gamma squeeze. There's 7 minutes left in the trading session. Makes sense that actually we're driving a little bit higher here, which I'll discuss momentarily. Okay, so hey, listen, we're just off of a marquee level. Okay. The other thing I like to explain to a lot of traders, especially the ones that are a little newer, is that when you look at the rally and people go, it's an unprecedented rally. First and foremost, right in here is a bit of a volatility box. And let me do a better job of actually boxing that off, if you will, because I think that this is critically important. This is a bit of a volatility box. And in this volatility box, yeah, we traded down to 3,600. We traded up though. And again, I will mention this gravity point just constantly because we just kept hitting it again and again and again and again. It's that 39.31. So we're pinging back and forth just back up to the 39.31. The rally actually kicked in after 39.31. We took off right to the 42.11. There's no, crazy expectations there. A pullback to 42.11 is almost, certainly in the cards at some point. Obviously, we could rally a little higher. Now, I do not want to disparage those that are wildly bullish right now and take away the idea that we could actually even head to 4,500. People, listen, there's sentiment out there, and the sentiment right now has been horrific. It's changing, and there's a lot of people looking at what is amounting to a short squeeze, and then they're hopping on the short squeeze. This week, there is evidence, okay, that retail trade truly hopped on a little bit of a short squeeze and got bullish, and they actually committed some more capital. But then you have to have a little concern because other asset classes started actually coming off a bit, and there is cause for concern because I saw asset classes even like Bitcoin, which actually is squeezing earlier in the week, it came off. Okay, like retail is alive and well, but some of the actions over there, they're definitely funky. Again, the fact that we saw the 46 million contracts trade yesterday, that option contract size, huge by huge. All right, so let's get down to business and what's really going on right here, right now. Okay, as I said, it's a little bit of a squeeze, and people are asking me, is it a pullback or a puke? What a pullback or a puke basically means is if you're caught inside of a short squeeze and you're uncomfortable with your positions, a lot of people get very uncomfortable in the midst of a squeeze. If we don't immediately pull back, they'll puke positions. How do you puke a short? Okay, by buying. That's it. So when you start to understand the context of a squeeze situation here, okay, and again, I want to show you exactly where we are. So this is the SPX, the mother of all products, and the SPX this week had plus or minus approximately an $87 move. Right? So we're looking for this $87 move. And what did we do? We hit it on Thursday to a T. We pretty much like hit that. We pulled in a little bit. Today we actually opened right in the upper edge of the expected move. Now we're actually squeezing above it. And you can feel it, you can taste it, you can just feel the squeeze right into the close. Of course, everybody's going to be talking about it's so wildly bullish, but right now we're caught in a gamma squeeze. And some people are puking that are short. And if you're puking when you're short, how do shorts get out of shorts? Okay, they cover. What is covering? It's buy. So they're buying. Let me explain to you exactly how a gamma squeeze, okay, happens. First and foremost, gamma squeeze often starts in the SPX. Okay, yes, other products can play significant roles, but the gamma squeeze often starts in the SPX when it pertains to the S&P 500. Look at the size that we traded today in the SPX. 2.1 million contracts of a $4,000, almost $300 product. That's sick amount of size. You want to see something even crazier? Okay, go look at the spiders. Now, I'm telling you right now, I haven't looked at this throughout the course of the day. Do another 6 million here in the spiders. I always make this point. You add up 6 million contracts of the spiders, okay, plus the 2 million that the SPX did, and you start realizing real quick, you're like, oh my gosh, like a quarter of all the volume that's even done in a given day is SPX or spiders. So how do you get caught up in this whole gamma squeeze thing, and what is the gamma squeeze? And I know that we're coming into the close, but neither here nor there, okay? The upper edge of the expected move where we started the day is kind of the happy place for risk. But the best way to actually explain the gamma squeeze to you, okay? Market making firms are very often trying to maintain delta, okay, very close to zero. They want some degree of delta neutrality. It's not a perfect delta of zero, okay? The reason it's actually called a gamma squeeze, gamma is the rate of change of your delta, okay? On an expiration day, specifically in the SPX, gamma, okay? Gamma for these trading firms can be huge. So their gamma, let's say, for example, okay, is hugely negative. And they're sitting on negative, I don't know, okay, 200,000, we'll say gamma. Every time the SPX actually moves a point, okay, that gamma comes slamming over into this delta column. And you go, I don't understand. Well, understand this. All of a sudden, the trading firm is sitting, okay, with a position that is short 200,000 SPX deltas. Do you think the trading firm wants to be short 2,000 or 200,000? Gotta add a zero to that. You think they want to be short 200,000 SPX deltas? You're crazy. No, they have to balance the equation. What do? Somewhere they got to go out there and find 200K of delta in the SPX. Where do they do it? The S&P futures. Okay, so how did this actually occur? As soon as we start trading outside here, yeah, there's some retail clients. The retail clients, they start buying calls and they buy calls and we start to spurt to the upside. But if we start to actually go to the upside, what happens is these trading firms get caught in it and they have to actually buy S&Ps to hedge, okay, the delta off. And most often these trading firms are actually going to be negative gamma, which implies that they're dealing with a crap load of risk when we go to the upside. So what are you actually saying over here? Well, I'm saying is the higher we go, the more short delta they get. The more short delta they get, the more long delta they have to add to zero out the equation. So they just keep buying S&P futures and away we go. And retail traders love it. And that's actually the whole, that's the plight of the gamma squeeze. Okay, and that's exactly what's driving this marketplace to the upside. Now, the exact same effect of the gamma squeeze to the upside, that can obviously happen to the downside. Lately, when we talk about lately, look, you've seen some big bursts to the upside, huge bursts to the downside. All of these are actually versions of gamma squeeze, right? This year, though, has been chaotic. I mean, how many breaches? There's the closing bell. It's over, man. It's over. Oh, we're up 1.7%. It is over. That is ugly. Okay. Market people, we're right outside the expected move. Outside the expected move. So the gamma squeeze is absolutely on. But this gamma squeeze, does it continue on Monday? Unequivocally, no. It doesn't continue on Monday. I mean, yeah, we can start squeezing to the upside because what happens is everybody's like, do you remember on Friday when we went to the upside? And they actually rush in and start buying calls in the morning on Monday. Nevertheless, though, that's it's over and done with. Now, let's get to some of the dark side of the force. Here's some of the dark side of the force. One of the things that I really want to point out to people before you get all happy-go-lucky in here is I'm going to go over to the spiders and just reiterate. We've seen some rip and rallies before, okay? But there's the old adage that you shouldn't fight the Fed. And this is a little bit of the opinion piece, okay? Well, when I say Fed pivot or market divot, I'm going to tell you right now, I don't think the Fed's going to pivot. The Fed may only increase by 50 basis points. How that is viewed as bullish, I'm not exactly sure. But, a half a point, rate hike is still a half point rate hike. That's, put on your big boy pants. We went from 25 basis points, 75 basis points to another 75 basis points. And here we are. Well, we're going to back it down to 50 basis points is still 50 basis points. So when we talk about Fed pivot or market divot, I'm obviously going to be in the market divot camp. And I'll be frank, like people have been emailing me all day and be like, people are saying the bull market's back on. Okay. You know what? Yeah, people said that right here too. And I can tell you 50 other times they said that. That's when you just have to block out stuff. It just doesn't make a difference. It doesn't matter what you think about direction. It doesn't matter what I think about direction. I'm the first one to tell you, we can get right up here to 450 inside of the spiders. Okay. Which is some decent upside over there. We can absolutely crater though and go right back to lows. Okay, the risk reward is not exactly wonderful here, but the one point that I want to make is, even though you see the VIX and the VIX has actually dropped. Okay, look at the VIX. Yeehaw! We're all the way back to where we were. Late March. Let's actually look at the spiders though. Where were the spiders in late March? Oh, we're back to exactly where we were when we rallied the last time. There's no surprise in VIX, but I do want to show you something interesting because when you look at the spiders and you think, oh, the volatility is dead. You looked at the spiders and you saw the rally, and then you looked at VIX and you saw VIX is under 20, volatility is dead. On the contrary, let me show you this. If you actually come over here to equities, take off the volume subgraph, hit apply, hit OK, then I'm going to come up over here. It says studies. Go to add study, go down to volatility studies, come up to historical volatility. It's the annualized standard deviation of past stock price movement. You're like, what I'm actually trying to show you here is real simple. Okay, volatility right now in terms of actual price movement hasn't really abated. It's actually still pretty freaking high, right? I got a better one for you. Go open up 3 years. Just average it for 3 years. Check it out for 3 years. I am sorry to say this, but we are still unequivocally in a crap fest of a market. Okay? Volatility almost needs new terminology right now. Price action in the marketplace, it's still big. I mean, if you're out there and you're, in this marketplace, you're surfing in some big waves. I mean, that historical volatility, which is averaged over the last 20 days, is still sitting very close to 19%, which is all kinds of chaos because you can look for years. Obviously, this is a huge spike here. That's the onset of COVID. But, even for years after that, this crap was down at like 10%. Now it's rocking at like 19%. Okay. Wait, there's more. Why don't you get crazy? And pull up even like a 5-year and use a daily. Don't use a weekly, use a daily over 5 years. Where are we? Okay. I'm going to tell you again, this is hell in a handbasket kind of stuff. I don't mean to freak you out, but don't you dare think that the volatility has subsided in the marketplace. The volatility, okay, is extreme to the upside. Why? Because you got a lot of retail traders that remember 2021, they're like, I can buy calls and make money. And all of a sudden, like earlier this week, we were talking about stuff like GameStop again, right? We're talking about stuff like AMC again, all right? Look at this stuff. They're squeezing back. And you go, yeah, those Wall Street people are back. Yeah, and it's only going to take one catalyst to unwind all of it. If you're bullish right now, I'm cool with it. Define your risk. I'm going to say that again. If you're bullish right now, totally cool with it. You better define your risk. Because I'm going to tell you, okay, it's been a great run, but great runs ain't never going to last, right? You need to understand that this business is one of the more diabolical businesses out there. And this is not the bear speaking in me. Okay, this is reality. A pullback to 42.11 should change the way you feel about the entire marketplace. Almost unequivocally, we're going to see another print at 42.11 this week, because at 42.11, okay, we're just a doorway right back down to the 39.31. We'll be pinging down here back up to the 42.11. This is not going to go quietly off in the night. That's why I wanted to show historical volatility. Okay, to compound some of the risks right now, we actually have Skew. Okay, Skew. Now, a lot of people aren't familiar with Skew. Skew is starting to pick up. It's the out of the money puts versus the out of the money calls. What I'm telling you is, by looking at Skew, and by the way, when you pull up Skew, okay, get crazy with it. I don't care. Pull up 5 years, pull up 10 years. Skew is still inherently low. If you actually pull up Skew, pretty much for the life of Skew, but it's picking up. All it's saying right now is that there is institutional hedging activity. There are put buyers out there. The other thing that really, this one actually sits not so well with me, and doesn't sit well with me in terms of like, being bullish or bearish. The dollar bidding up today is very defensive. There's no question about it. It's defensive. Okay. But the dollar just staying above like the 100 level here. And this is just, dollar sign DXY, but the dollar staying above the 100 level is just not good for inflation. So any way you want to cut it, the dollar being where it presently is and rallying right now can't be good for inflation. It's going to be entrenched. Okay, so we have Skew that's up, which is just indicative of some people hedging. The dollar remains extremely defensive. And what sectors are actually, driving, and what are we looking for in terms of reversal? Driving sector this week unequivocally is the financials. Financials well outside 2 deviation move. So this is a 1 deviation move, obviously be the edge of the expected move. It's 2 deviation move inside of none other than the financials. Take a look at the energy sector. The energy sector too is fairly wicked. What did the Nasdaq do? By the way, when we talk about sectors, like this sector, that sector, listen, what's really driving markets right now? You've got financials, you've got energy, and you've got tech. So let's go ahead and bring up the Qs. The Qs, they made a stellar move. Qs barely made it to the edge of the expected move. The S&Ps, okay, way outpaced those. S&Ps blew to the upside, but the S&Ps were actually being driven by the financials. If you're going to be looking for any sort of a reversal, it's coming by means of the financials, which actually brings up the bonds. Interestingly enough, the bonds rallied a little bit today, but they've actually been in a downtrend. If the bonds are downtrending, that's interest rates up. Maybe interest rates up is supposed to help financials, but if the bonds continue to downtrend, it's going to kill tech. That actually caused a little bit of a reversal yesterday because the bonds were down big. People, there is a lot to think about over here, because the driving sectors in the marketplace, the first and foremost thing you want to think about is if there's any reversal whatsoever inside of the financials, it's going to take the S&Ps down with it. That's actually been the driving factor. Okay. Prior to that, what was the marketplace? It's all about Apple. Okay. Apple's only a stone's throw off its all-time high. Put it in perspective. Okay, you've had a marketplace just get decimated, but on a year-to-date basis, Apple's only down 5%. You realize that the fate of the world rests a little bit in Apple, and I'll say it again, also rests heavily with Tesla. Okay, Nvidia actually picked up a little bit, but it's got earnings coming out, and that's going to be a tough one. Nevertheless, okay, you've got to watch financials in this next week of trade. Okay, you've got to watch individual products like Apple, which hasn't really had much of a downtick over here, which unto itself makes it incredibly vulnerable to bigger moves. Last but not least, each and every week, of course, we talk, okay, just incessantly about expected move, and that is, what's the marketplace anticipating risk to be? So in this last week of trade, we were looking for this $87 move. And again, I want to write it up here, okay? But before I do, you can see the $87 move, and we blew outside of it. What was the actual move in here? Well, for the most part, the upside of the expected move, and I really want to zoom into this, the week started roughly, okay, 41.45. Okay, where did we end up? 42.80. You're like, ooh, that's huge. Okay, when you're blowing through expected move, and it's a few points, it's 10 points here, 10 points there, means nothing. When you blow through expected move to this magnitude, again, that's where I say volatility is very much alive, and the options marketplace is doing a terrible job of handicapping risk. So I come over in the SPX to the trade tab here on thinkorswim, and I open up, okay, 7 days, and I want you to see, ironically, okay, the expected move has actually dropped. By the way, the expected move does not settle, okay, does not settle until 15 minutes after the close. So if you're in Chicago, it's 3:15 Eastern time. Of course, it's 4:15. Here I am on Pacific time at 1:15. I'll actually be able to take the expected move, but it's $76, okay? And I'm going to tell you right now, that is way low. It's crazy low. Why $76 move? Okay, you just had a 70-point move today. What are they thinking over here? Okay, expect once again wild and woolly moves inside of the SPX. Okay, if you're going to do anything in the short duration options in the SPX, be a net buyer, because if you were a net buyer of those options this past week, you made money. Okay, you don't sell short duration options right now in the SPX. If you're going to sell anything, you got to go considerably further out in time. With that, again, there's not a tremendous number of catalysts to drive market direction per se this next week. Okay. However, there's enough Fed speak unto which pay attention, because I'm going to tell you right now, okay, the freight train isn't slowing down. Okay. And they're not going to be happy until they break something, and they being the Fed. Nothing is broken in this marketplace. All right. And to slow inflation, you're going to have to inflict some damage. Damage has yet to be inflicted, not only upon the marketplace, okay, but the bottom line economy. That is the driver of inflation. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.